Luke, welcome to the podcast. Luke Hajdukiewicz is the Chief Growth Officer at Blueprint Finance, where he leads institutional capital partnerships, protocol expansion, and Vault infrastructure strategy across Concrete and Glow. Prior to Blueprint, Luke has held senior leadership roles at EigenLabs and BitGo, where he helped scale EigenLayer's validator ecosystem and drove over $30 billion in institutional asset growth across staking, custody, and DeFi integrations. Lucas began his career underwriting underwriting venture and credit strategies at Silicon Valley Bank, and later played a foundational role at Height Zero, which has been acquired by BitGo. His work consistently bridges regulated financial infrastructure with cutting-edge digital asset architecture, specializing in restaking, qualified custody, and cross-chain yield deployment. First and foremost, walk me through your journey from, I imagine, more traditional finance, stepping into the Web3 crypto blockchain world.
Yeah, I mean, my degree is actually in environmental engineering. I was like very, very interested in um like the environmental initiatives that were going on around 2015, 2016. When I left college, I was super, super interested in maintaining some sort of connection to that side of my life and like what I was interested in. And that's why I went to Silicon Valley Bank. When I was at Silicon Valley Bank, I actually split my time half between like environmental underwriting. So like a lot of the project finance stuff for um, like solar farms and things like that. And then the other half was focused on FinTech. Now, when I was doing all this FinTech stuff, I kind of identified how interesting it was, and honestly how environmentally efficient it was to start looking at some of these things that were largely like very physical businesses and incredibly complex, and that were being like put online and largely being driven with a like very light environmental footprint. Now that led me down like the rabbit hole of seeing some of the stuff that was going on in crypto, and obviously there's a lot of problems with the environmental components of crypto. So I was very, very interested in like what are the most environmentally inefficient systems in traditional finance, and how are we putting them on chain, and then how do we make the on chain world more and more environmentally effective. So that's actually how I got into crypto. And then I was very, very focused and had a bunch of friends that were existing in this like super regulated space in crypto. And I really got involved in like, how do we actually think of this? Was way prior to ETFs, way prior to all this stuff. Is like, how does a financial advisor get exposure to Bitcoin and ETH for their clients when someone dies, and now all of a sudden someone younger has the family trust and wants some exposure to crypto? Got super involved in that world. Really, really interesting. I think we were really early there. That got bought by BitGo. Spent a bunch of time at BitGo, went further down the rabbit hole into coin projects, L1s, L2s, that whole ecosystem, how those guys think about managing their treasuries. I spent a bunch of years at BitGo doing that specific work, and that $30-40 billion was largely oriented around that. And then went to a small startup called Rio, which is a liquid restaking token on EigenLayer. That got bought by EigenLayer about 3 months after I joined. So that one had very little to do with me. And then spent a couple of years as a head of sales at EigenLayer before joining Concrete. So had a relatively windy journey from super regulated down the rabbit hole of crypto to largely more the transparent finance world that we're trying to like bring on chain.
Yeah. So before we dive into the world of crypto, I want to talk about that environment aspect you mentioned earlier. So as we
Mm-hmm.
know, proof of work can be very energy consumptuous, to say the least. I mean,
Mm-hmm.
I believe just mining Bitcoin consumes more energy than countries combined, like
Yep.
Argentina or Norway. And from one end of the spectrum, you could say, hey, that doesn't sound environmentally friendly, but the benefits, I think there's an argument to be made that the benefits outweigh the cost, even from an environmental perspective, where the amount of energy you're saving by having trustless systems, by cutting out the middlemen, by greatly increasing efficiency. Uh, and a lot of times, energy consumed to do proof of work are in energy excessive places. So you're not
Mm-hmm.
necessarily mining Bitcoin in your basement in the United States. You're generally like in really, really cold atmospheres, so you can save costs on cooling systems and whatnot. So explain to me that like dichotomy or that back and forth argument with whether Bitcoin is truly environmentally friendly or not.
I don't think it is, at least in its current state. I think more my perspective on this is one side of the funnel is incredibly opaque and one side is incredibly transparent. We know exactly the amount of energy utilization that it takes to like mine a Bitcoin. When we look at how these systems are traditionally run, whether it's um, like bonds or gold or whatever it may be, and how that's transferred from place to another place. When you go from like fully decentralized teams that exist in their homes to these massive skyscrapers and the energy output that exists for people to come to an office now, what feels like 2 or 3 times a week max. I think what I believe is the focus here is if we can increase transparency, we can solve a problem. If there's an opacity around the problem, it's very, very difficult for us to quantify how do we actually fix it, right? So I think whether it's the environmental impact or whether it's hacks or whether it's money being stolen, the ironic thing is we've added so much transparency to the system that it actually creates some people that just point at it and go, that's the problem. When in reality, it's like if you look at the traditional systems, how these things work, they have the same exact problems. You just can't tell like how much money is actually being um, is being executed through like fraud and things like that, and how much like credit card chargebacks there are that create massive
Yeah.
issues for our system, and that's because it's intentionally opaque, right? And I think that as we go further and further down the transparency rabbit hole, um, through like digital assets, I think that's going to further perpetuate like environmental improvements, fraud improvements, those kind of things that will be largely beneficial for for society. But I don't think we're there yet. I still think it's like an
Yeah.
incredible.
Jumping into stablecoins for just a moment. So, finally we're getting some clarity and, stablecoins, to someone who doesn't understand what stablecoins are, explain to them how this is going to bridge the gap between the traditional finance world and the digital world and why this can just monumentally change the trajectory of crypto as it is now.
Yeah, I mean, when I was at Silicon Valley Bank, this is actually like one of the first things that got me into crypto, which I found really interesting. And God, the name evades me of like what the initial company was called, but the example I always use is Western Union. And Western Union and cross-border payments is specifically to families in the United States paying family members, whether they are in Mexico, whether in South America, or whether they're in Africa. The amount of parties involved in a singular transaction is greater than 8 parties. The amount of fees that are taken for someone sending money to their family in US dollars to whatever FX currency that country is based upon is normally between 25 and 45% of the overall amount of money. So I think that the reason you've seen such an explosion, why stablecoins like actually matter, at least in my perspective, is that it cuts out all the middlemen that are not providing value in the system, because technology has replaced what made that system initially super, super complex. So what is incredibly valuable is someone that is earning US dollars is able to buy or mint USDT or USDC, whatever the asset may be. They're able to send it to a family member in Namibia for 10 cents versus 35% of the overall $1,000. And then once that money is in that person's account, they can just off ramp it in their local currency, and the fees are far, far less than any of these parties. So I think in general, like why I think stablecoins are by far one of the largest innovations is we've gone from the system of multiple middlemen taking their cut to peer-to-peer transactions that are like largely trustless and can be sent from one person to the other incredibly fast and with incredibly high conviction.
Yeah, totally. And there's constant talk about decentralization.
Mhm.
Decentralization. That's like the focus of everything crypto, blockchain. Do you think the future is purely decentralized? Because it's not like it's an engineering trade-off, right? So to
Mhm.
have a central authority, yeah, of course, just puts too much power in one central spot. But also there's recourse. I mean, you even mentioned the word chargebacks. And there's a big problem in the crypto industry is because someone like you, Luke, who's super technical, understands how to custody their assets, understands how to send their assets. But we really don't have that robust UI UX system. Think of it akin to even like, today when you send an email, you don't have to understand how TCP IP works. You don't have to understand the layers of moving packets from one place to another and how to detect if a header or demarc and all these things. you just send an email. You don't necessarily care how it works. It's almost magical to some extent. We don't really have that yet in the crypto world. And the whole idea of a central authority, to be honest, to many people might bring peace of mind. Like, I don't want to have to hide my money under my bed, right? I'm okay. Of course there's pros and cons, but I'm okay for now trusting a bank to hold on to it to some extent. But when we head, so my question to you is, first of all, do you see it purely as just a benefit in every capacity to be purely decentralized, in, including the cost that comes with hacks and just sending money to the wrong place and all those problems that someone who's not super technical might be able to navigate? Or do you see it as like this, fundamental layers, perhaps decentralized, and then you have these systems and companies that build on top of them that do have these central authorities that we still confide in?
Um, I probably have like a relatively intense view on this, that I think that there are very few legitimate parties in the world that are moving large amounts of capital that don't want a neck to choke if something goes wrong. Like it's just the reality of the situation is everyone wants to point a finger when something goes wrong and say, hey, this person lost me money, or this person did something incorrectly, or this person stole my money, right? The concept of these decentralized systems and largely being oriented around universal decision making on how things are actually executed is incredible in concept, right? But there are so many nuances to how tokens are allocated, where they're allocated, how people can manipulate governance votes and things like that. I think that there will always be central powers in decentralized systems, and my perspective is that they will coexist. I think that there are places where decentralized systems make the most sense, whether that's something like TEEs or ZK proofs, where largely it's oriented around privacy. But when you talk about financial transactions, when you talk about money moving hands, I do think that the buck has to stop with someone, and being able to have those parties to look at and analyze what went wrong and hold people accountable that do the wrong thing is incredibly important. I think right now there's a lot of parties that exist where decentralization is a kind of a cop out in some ways. The way that I would say it is like, they're like, oh, the system's decentralized, so we like don't hold any risk, right? And I think that's largely like a flawed thought process, because it's very
Mm,
difficult to go and get people to be committed to a system or whatever it may be if they feel like key parties could leave at any point, and that the decentralized system could potentially like continue to run without that like decision maker that is there. And people invest in people, right? And people invest in the systems that they build. But I think that decentralized systems have a place, but they will definitely be a part of the solution, not the entire solution.
yeah. So now, speaking of application, this industry is changing so fast that this conversation could be different tomorrow. But what kind of crypto-related products or services are institutions actually using and offering today?
I think it depends on the institution. I mean, I think I've seen kind of everything from like, when I started my career at BitGo. We were doing a lot in the NFT space with the people like the Nikes of the world and the Disneys of the world, and you see this kind of tokenization of real world assets in their most general form, right? Um, I still think that like the NFT movement has a lot of legs behind it, and I think that there are applications that people aren't necessarily considering that are going to be incredibly important, specifically around
Mm,
like NFT lending and collectible based lending on being able to get cash against your assets. I think that's like a really interesting thing that people haven't been able to truly monetize or explore in a really long time. I then moved into like the concept of L1s and L2s and selling those to large organizations, and how they look at like building their own financial systems and their own networks in private like blockchain manner. Like if you look at things like ZK Sync, Providium, and some of the other stuff that's going on in this space, um, companies are building their entire like blockchain transaction based stack because it's just more efficient. Um, And then today, I think a lot of what I'm now focused on is largely like the yield management and reward management systems, and how do we look at making assets productive in a system where it's incredibly difficult to understand what are legitimate protocols, how are there ways to get some sort of delta neutral exposure to an ecosystem, and things like you see the stream finance blow up and things like that that have happened recently, and the concept of asset curation and strategy management is something that I think is like rife with so much uh, negativity and bad actors that for me, like largely the reason I moved is I think that those are the spaces that when mature adults in the room come in and find a solution, that there's a lot of growth that can be had to bring new players into the ecosystem and help them be successful.
Yeah. So I want to talk about October 10th for just a moment. So, we were talking about stable coins and FTX, of course, is one of the things that come to mind. I know the concept of stable
Mhm.
coins has evolved over time, but stuff like this can really scare the system for a while. And, talk about what happened on October 10th with that mass cascading liquidation event. And how do you think, if at all, it's going to play into the greater mindset of the industry?
I mean, I think it should, like, more broadly play into the mind of the ecosystem and crypto in general. I think that, largely yield management and asset management has been oriented around, like, the risk-free rate, and people perceive the risk-free rate basically being incentives that people are giving away for free from VC excess, right? Is some VC puts 100 million, $200 million into a new ecosystem, that new ecosystem, um, like launches a token and they give away a majority or some of that token to basically incentivize some sort of action, right? So that flow creates a lot of recursive loops. That's where someone is taking an asset, they are then lending that asset, they are then borrowing the same asset, and then they are putting that into some sort of loop, right? Now that works and that is great in like incredibly positive times where there's positive sentiment, there's no cascading liquidations, there's good liquidity all over the place. Um, all of that can be potentially positive to LPs and to people that are investing in the space. Now the problem is when things get bad, um, those recursive loops can break very, very easily. Whether it's an
Mm,
Oracle depeg or whether anything happens that potentially flips the incentivization mechanism, you now have 8 to 10x the exposure you have, and a 1% change now looks like a order of magnitude much larger than that that can cause these cascading liquidations. So like my perception and like what we talk to LPs about is that there is no such thing as a risk-free rate. If you're getting yield for doing something, there is some sort of risk, whether that's T-bills, whether that's a delta neutral strategy, whether that's a leverage loop, there is always a risk in anything that you do that has some sort of reward. So how we orient around how we like produce like additional rewards is oriented around understanding the parameters of what a liquidity provider is looking to get for their asset. If they say they want to earn 2% on their BTC, it's what is the least amount of risk we can get to get you 2% in your BTC. If you want to get 25% on stablecoins, like there's going to be significantly more risk, but that is largely oriented around a different problem, right? And those are different clients, different risk profiles, and it's incredibly important for things like 1010 that people understand the risk they're taking. These things are natural and good for a system to have these sort of like liquidations where risk is measured out of the system. But it's important that the people that are taking that risk understand the risk they're taking prior to getting involved in the system itself.
yeah. Yeah, and it seems like that risk has not dawned on too many people because you still see just the open interest and the leverage for Bitcoin just doesn't stop, and it's like people
Never.
don't learn. They don't learn. I mean, you look at the liquidation heat maps, and it's just like there is no amount of smart money hunting these people down and just creating liquidity in the market. It never ends. It blows my mind. Um, Now I want to talk about for just a moment the investment landscape. So first of all, institution. This is the institutional bull run, is what a lot of people are saying. How institutions have finally really started to take crypto seriously. I think it's perhaps because we reached that 100K psychological barrier, where that like we kind of like crossed the Rubicon of, or we shifted that Overton window of conversation of, hey, Bitcoin is going to go to zero. It's a speculative asset. It's not worth
Hmm.
anything. There's no intrinsic value, to saying, hey, we should start jumping on this. I mean, you see JP Morgan, Chase kind of, initially not taking it seriously, and now they're kind of, at least vocally, they're kind of bullish to some capacity. They just projected today that I think in the next, I think it's like next year, they project Bitcoin to be at 170K. I want to know, my question to you is what kind of role, like how has institutions shifted this ecosystem, and what kind of role do you think is going to play in the next year or two?
Yeah, I mean, when I started, when we were trying to get BTC and ETH, and specifically BTC to financial advisors, those conversations were absolutely horrendous, right? Like the conversation was, how is this not a scam? And like, what are we actually buying, right? Like there was a fundamental lack of belief in the asset class as a whole, right?
Di
And
didn't it feel
largely,
like didn't it feel like, sorry to cut you off, but didn't it feel like
no, go
explaining
ahead.
to, like, your mom, like,
Oh, it was
what
worse, dude.
email is like, or
No, no, it
and
was
and you
worse. It was.
and you're kinda like, maybe they're not supposed to get it, and maybe, like, this is a transfer of wealth from the people who intrinsically get it to the people who are gonna hold on to their US dollars while it gets devalued over time.
Yeah, I mean, I think that's like, man, like, and this is like where like a lot of this stuff like circles back to the environmental side of things. Like, I used to have this class that largely talked about like environmental conservation. And do you do environmental conservation by allowing for normal people to be in national parks, or do you make national parks incredibly wild and basically only allow people that exist there in the hope and the expectation that like those people will be the most ferocious to protect it and to make it as great as possible, right? And I think it's two completely different viewpoints. Now, my perception and like my thought process and kind of like my thesis for my entire career has been, if you can be an adult in the room where no one else is the adult, it makes it very easy to get slugs of money out of places that other people weren't even like thinking about potentially getting their money, right? Like financial advisors in RIAs in the United States is one of the largest um, like markets in the entire planet, right? My thought process was, if we can activate 1% of that money, like we are a $100 million billion company before we get purchased, right? Now, we didn't even access that much. We accessed like a couple $100 million before we got bought. But like those conversations were brutal because it was largely about like, is this a scam? Now, the conversation
Mm,
today is, how do I make sure I don't get fired as a financial advisor for not getting my clients exposure, right? And that's like where this life cycle change is happening. Those are the people that are like, hey, we want to get you alternative asset exposure. It's not, hey, we want your 50% of your portfolio to be crypto. It's, we want 2%, but 2% over this large swath of assets is what is driving a lot of this like this price movement, right? So my my overall perspective on institutions coming into the space is, the more passive money we can get in this space, the better. The less like
yeah,
evangelical action we can take to basically go and compel people to believe in the thesis of Bitcoin or the thesis of digital assets as a whole is like a losing battle, right? You have two different sides of this. You have the monetary component, and then you have the like technical component. The technical component, people get it. Like people will continue to move into this space because they understand that it's faster and it's cheaper and you cut out more middlemen. People are just going to
mm,
continue to get that. But like if you look at a bank, why the hell would they ever accept peer-to-peer lending? It literally
yeah,
cuts them completely out of the flow, right? So it is a forcing function of people identifying that the savings rate they get is ridiculously low in comparison to a peer-to-peer lending market that's fully collateralized, right? So like those are the conversations we have and how we move people away from some of this stuff. But I think that institutions have changed in the way that they've accepted it's a reality and that they will be left behind if they don't have some sort of
yeah,
solution, but they're going to continue to slow roll it in the hopes that they can generate as much revenue before these things continue to cannibalize their business across the board, or regulation comes in and makes crypto nearly impossible for like these peer-to-peer systems to exist, and people have to go to the banking-based systems in digital assets to actually get anything close to the rates that they get in traditional markets.
Yeah, that's so well said. I feel like the banks are like, hey, the 100K barrier here. It's like if we can't beat it, let's like become it or take it
Exactly.
over. And I mean, looking at the market, when you look at how it's just so strangely volatile, how like, you'll have all this upward pressure and then it'll just strangely dip downwards, clear all that leverage
Mhm,
and hit all those stop losses and then head right back up within 20
mhm.
minutes. Do you feel like there's a great degree of manipulation in the market, or is it just, just that's just how things behave?
Uh, I think there it depends on what you mean by manipulation, right? Like in any market, there are people clearing out risk. There's people taking profits. There are people that understand that they move the market, right? And this
I'm
is the
talking
same
like
exact thing. Like,
concerted, coordinated events, like even something like October 10th. Like there's something about that that just seems strange. Like just altcoins dipped 92%. Some altcoins dipped 92% for like 45 seconds. And that's just like
yeah.
cleared the liquidation books completely. And it kind of felt like, right before Trump's announcement, you have these like whale wallets open these huge, huge, highly leveraged short trades.
Mhm,
Yeah, I don't mean to put the tinfoil hat on, but just curious to get a feel of these are like, you compare to the, like, I mean, people got to put this in perspective. The amount of capital that left gold in the past 2-3 weeks was like $4 trillion, something like that.
mhm.
That's greater than the entire crypto market cap. So
Yeah.
people look at crypto as being this huge thing. It's still this tiny thing. It's this tiny thing that's extremely volatile that has an overall upwards trajectory. I mean, to me, it's like money makers and people who can control the markets. I can only imagine are just having a field day with this. And who are the people who are used to causing me volatile? These are people who are not educated on the market. They're retail. They're panic selling. They're doing the exact opposite.
Mhm.
They're playing with emotion. Kind of seems like the perfect storm for a bad actor to kind of start to have a little bit of fun and pull the strings behind the scene.
Yeah, and maybe this is like where it's a great question. I think that if you look at esoteric markets across the board, whether that's penny stocks or whether that's unique FX or whether that's like things outside of the S&P 500, um, manipulation versus identifying that there's an asymmetry in the market that you can take advantage of are very different things. Now, if we're talking
Mm,
about like Trump's announcement and someone being able to go and front run that news, that's someone that has privileged information and is utilizing it. Like we would call that like insider trading and illegal in the United States. But I think that there's fundamentally a difference between that and there are people that can push their weight around the market and know that they push if they sell their assets, the liquidations that would follow that are going to basically allow them to buy the asset at a cheaper dip.
right.
Like that's what quantitative traders do. Like that's what people are doing across all these different markets. And the issue, not even the issue with crypto, but the issue with crypto is that the sizes are so much smaller. So people are allowed to push around the markets with very sophisticated systems and tools that they aren't able to do in traditional finance because the
Yeah.
markets are too big. They can't push those things around, right? So I think in general, um, my perception and what I will talk to people about like what I do is like I haven't touched anything in years. Like I just like I'm not smart enough. I know I'm not smart enough. I will never be able to understand what people are doing in the market and when the top or the bottom of the market is. I think that where you lose in crypto is by investing in things you don't understand, and
Mm,
that you just hear on the news because there are a lot of people that have other incentives to be able to sell something, whether that's they have advisory shares or whether they have the token earlier than everyone else. Like the
yeah.
pump.fun stuff, I think is the best example. And everyone should go and
Yeah.
look at like how many people lose money on pump.fun versus make money on pump.fun. There's privileged information and there are people that are better at it than
100%.
a 99% of people. And those are the people that
100%.
consistently win and win everything. And I think that's my big perspective is like just don't think you're smarter than everyone unless you are smarter than everyone and you have a way to prove that you're smarter than everyone and can show it over years and years of time.
Yeah, people are blinded by this, like, altcoins constantly go up. They go up for a very short period of time relative to Bitcoin. If you had just held Bitcoin, I mean, if you look at just Bitcoin relative to any other altcoin, it's been bleeding
Yeah.
for years now. And the idea that you can just ride this wave for 20, 30 minutes and get rich quick is really a pipe dream. And, for every one person that does it, there's 100,000, hundreds and hundreds of people who get burned on the way. And, it's taking a realistic and a pragmatic approach here really is all the difference. And you mentioned something really interesting. You mentioned earlier on that, it's like the first time you present and you started presenting crypto or like Bitcoin, you're like, hey, people are asking you, hey, how is this a scam? And now it's like your pressure to kind of say, hey, listen, you should allocate some portion of your portfolio. I can only
Mhm,
imagine, like, people don't want to make money. People want to beat something like the S&P 500. People want
mhm.
to, that's why they're coming to you. Because if they wanted to make 10, 15%, they would go, well, that would be a good year. They would go into the S&P 500. And Bitcoin has outperformed the S&P 500 every single year. We're in a very interesting position where who knows what's going on? You have nothing but bullish news. You had the sort of news that if we had this sort of news 2 years ago, Bitcoin would blow through the roof.
Mhm.
And it's kind of hasn't really, it's at its same price point from like a year, and just altcoins are dead. And I only imagine it's like a tough position to be in, because it's like you have people saying, "Hey, the S&P is at all-time highs. Like the
Mhm.
S&P has been making so much more money. Don't like financial advisors or people who are managing the money have to do better than the S&P?" And it's just like, "Hey, now what do we do? Gold is topped out. The S&P is just doing really well, and it's just like crypto's kind of stagnant." I'm curious about your perspective on that.
Um, First of all, like my more broad perspective on financial advisors is their goal is to preserve wealth, right? Like they don't get fired for not beating the S&P 500. They get fired for losing 30% of their portfolio over the
Mm,
course of a year, right? So I think that in general, that was why the conversation around crypto was so brutal, because you saw this like 90% drop in BTC or 75% drop. And it's like, hey, if they had allocated 20% of their portfolio, that's something you get fired over, right?
right.
Um, I think that like the way that I've seen this market grow and proliferate is that BTC is now perceived as like another alternative asset that is almost like anti-government, and that's probably not a fair way to fully describe it. But I think it shows like a really interesting point is that people that are largely skeptical of the U.S. dollar, there's very few assets other than gold that you can get exposure to, right?
Mm,
So I think that that's a very interesting way that we're now seeing it presented in the market.
yeah.
And candidly, like I don't even spend that much time talking to people that don't have any exposure to crypto anymore, because it's very rare to find those people, right? Like
Mm,
all these financial advisors, all these people are holding BlackRock's ETFs, and they're holding these other assets because people are asking for it, right? And my job now is looking at exactly the problem that you're talking about, which is like, hey, you have BTC that's relatively stagnant. These people got in at $9,000 and it's now at $100,000, right? How do we make this thing productive? Because you don't want to sell out of it, because then you're going to have a massive tax bill, or you're going to have some issues to basically sell out of those assets, or it's going to create some significant slippage or whatever it may be. So like a lot of what I spend my time doing now is how do we ensure that you continue to have positive value attribution, even if this market is not going to continue to be a market that you're getting a 1,000x or you're getting 100x on your Bitcoin anymore. Like that doesn't exist in the next year or in the next 2 years, right? So how do we make sure this asset's productive, that you're able to continue to generate like incremental wealth and treat this like the S&P, or treat this like a different asset where you're looking to generate like between 4 and 7%. And if you're doing that on your BTC, that's a great year. And that's like a lot of what we're seeing and what I've seen as like the growth in this space. And I think you're going to see that with like digital asset treasuries and other things. It's like these guys aren't going to be focused on Bitcoin 1,000xing. They're going to be focused on generating incremental returns for their users.
Mm. What current bottlenecks do you see in the industry? And should those bottlenecks be solved, where do you see things if you had to speculate in the next 5 years?
Um,
It's a very tough question because things can change by the day, but yeah.
yeah, I mean, I think that um, this is an incredibly cyclical market, and I think history repeats itself like very, very frequently in digital assets. I mean, I think that my perception is there's a consolidation in the market where everyone goes and they all come back to 4 or 5 assets. Now those assets normally change. Right now it's looking like BTC and ETH and Solana and XRP. Um,
You're also seeing the
those spots
narrative.
always for anyone.
Yeah, and you're
Yeah,
also
go ahead.
seeing, you mentioned privacy. I mean, you're seeing the narrative of privacy play out quite interestingly with Zcash and
Yeah, see, those
privacy
kind of things are
tokens.
so interesting to me because like those seem to largely sentiment driven more than they seem like anything fundamental. It seems like people are just really excited about it, and then everyone kind of hops on board with it. But like you look at Zcash versus um things like Alio and things like ZK Sync and some of these other assets. Like Zcash has been so successful for so long because it's like one of those like OG tokens, right?
Right.
But the fact is, like, there's no infrastructure that's very interesting built around Zcash, right? So it's like there's nothing really like maybe it's something, maybe I'm completely wrong, but like
No,
I
well,
haven't talked
I
to.
mean,
Yeah, go ahead.
it's like what made Bitcoin amazing was that, it is the OG coin, and, it's a simple, and there's a finite amount of them, but I believe Satoshi mentioned in his early conversations where he was like, I would love to make Bitcoin private. I just can't. The math is not really there yet. I can't do both and solve the double spending problem while making transactions hidden. And I think as years moved on, I think Zcash said, hey, no, the cryptography and the math is here now, and this is how it's done. So it's kind of like if you were to if you were to take the math and go back in a time machine and hand it over to Satoshi, Bitcoin would technically be something more like Zcash, which is just an interesting perspective.
Yeah, totally. I mean, and that's the thing is like these things are worth something until they're not. I
Yeah,
think whether you're talking about crypto or
that's
whether you're
right.
talking about the US dollar or whether you're talking about gold, right? Like these things are worth something until someone goes, no, it's not worth anything anymore, right? So like I think my perspective is that it's always around sentiment. It's always around human sentiment. Whether you're talking about anything in the S&P 500 or whether you're talking about commodities or whether you're talking, there's very few assets. I think there's a lot of stuff like water and things like rare earth minerals that like there's a finite supply and we really need to figure out how to properly price those assets. But I think that like these, I can't remember what your initial question was, but like I do.
Where you see the industry in 5 years
Oh,
from now?
oh, yeah, yeah.
Yeah, we're
Um,
all over the place. I forgive you.
I think in 10 years, like my positive spin on things is that there has been a very interesting blend of crypto, AI, and the environment that leads to a very like utopian space. I think that AI is growing much faster than we could ever imagine. I think that there are like very real problems in the environment that need to be solved, and I think crypto allows for things to be uh, tokenized and allows things for to be like properly shared that I think is really interesting. I think that the question is like, does it happen via benevolent dictator or government intervention or like human kindness? I don't know which route we go. Um, but I do think that there's a very interesting reality where all three of those things converge in a place where we kind of need to make a decision. There's very few things that can be decentralized across the entire planet, oriented around a similar goal and utilizing something that is able to homogenize humans into a very simple algorithm. So that's not really an answer to your question, but I do think that I think that's going to be like a large focus, at least for me, like over the next 5 years, is like how do those things kind of blend together?
Yeah, I mean, I personally wouldn't be worried about the benevolence of dictators or people or governments. I would be more concerned about the benevolence of AI. But
Yeah.
it's anyone's guess. But I appreciate your
Maybe
utopian
that
view
is
on
a
this.
benevolent dictator, right? Like maybe that's a
Yeah,
benevolent dictator that comes
yeah,
into the
yeah,
system.
yeah. It's like, but don't worry, we have the off switch. E- e- Great conversation, great conversation. And Luke, how can people get in touch with you?
I am always available on LinkedIn. Feel free to reach out to me via email. Do you put it in like the call description or the email, the video
Sure. Yeah,
description
yeah,
or
yeah, yeah.
something? Yeah,
We
you
put it
can
in.
always do that. And people are always like, I'm always happy to have a chat about any of this stuff.
LinkedIn it is. Luke, I appreciate your
LinkedIn
time
is.
and wisdom. It's been an honest pleasure talking with you.
Yeah, it was great to meet you.